this period is fairly inevitable. And any asset that becomes a $1 trillion liquid asset is going to get ETFs built on it in some jurisdictions. Bitcoin didn't make the ETFs. The fiat system made ETFs for Bitcoin.
Lyn Alden starts by addressing the inevitability of Bitcoin ETFs exchange-traded funds. As Bitcoin grows into a $1 trillion asset class, the creation of ETFs was bound to happen. Despite resistance from regulatory bodies like the SEC, the court's decisions reflect the demand from investors and various capital pools, such as retirement accounts and managed assets, to access Bitcoin in a regulated manner. This shift is significant as it provides broader accessibility to Bitcoin, moving beyond the constraints of entities like Grayscale and allowing more professional and cost-effective management options. The introduction of Bitcoin ETFs is a game-changer for investors who have been unable to incorporate Bitcoin into their portfolios due to regulatory or institutional limitations. Alden highlights that many investors now have the opportunity to include Bitcoin in their retirement accounts or managed assets, which was previously restricted. This increased accessibility is not merely a trend, but an inevitable progression as Bitcoin becomes a mainstream asset. Alden acknowledges the concerns regarding centralization that come with the advent of Bitcoin ETFs. However, she argues that these concerns might be overstated. The centralization issue is not new. Bitcoin has always had significant portions held by large custodians like Grayscale. The shift to other custodians such as BlackRock and Fidelity doesn't change the overall dynamics dramatically, but rather diversifies the custodial landscape.
This period is fairly inevitable. And any asset that becomes a $1 trillion liquid asset is going to get ETFs built on it in some jurisdictions. And in the United States case, we have some degree of separation of powers. And so even though the SEC didn't particularly want this, they lost in court. And so people want this. And so now more people can access it. There are pools of capital that, there's retirement accounts, there's managed assets, and a lot of them have not been able to access it. And now they can. So, and there's like imbalances built up. So the fact that they could only access it with like Grayscale has been an issue. And now there's kind of like this big release valve where a lot of capital can finally get out of that big entrapment and move to other places that are kind of more professionally managed or cheaper and things like that. So I think that's a process that's inevitable. I think concerns around centralization are somewhat overblown. Not to say that they shouldn't be brought up, but basically I think that there already was a pretty big chunk of Bitcoin sitting in Grayscale. Now it's rotating into BlackRock and Fidelity and a few others. The overall pie is growing moderately that's in those environments. A lot of people in those environments, they prefer that. Whereas I think it's important to say make self-custody reasonably easy for people to make sure people understand the risks. But I think, again, it's just people have more optionality now. There are a lot of people that wanted to have Bitcoin in their 401k and couldn't. Now they have more options, or they have assets with an RIA, and he or she is just unable or unwilling to put some of that money into Bitcoin. Now they can. And so I think that's inevitable. Even if it's not good or bad, it's just inevitable, right? So it's not like I see people saying, oh, Bitcoin deviated from its mission because ETFs exist for it now. Well, it's like, well, Bitcoin didn't make the ETFs. The fiat system made ETFs for Bitcoin. And that's basically the fiat system upgraded its APIs to plug Bitcoin in this method. ETFs are basically an API into different asset classes. They decided to plug into Bitcoin now. And, you watch out for big centralized honeypots, whether it's ETFs, whether it's Binance, whenever a lot of Bitcoin are in one big custodian, that is a risk. So right now, a lot of them are in Coinbase. I consider that not ideal. So I think people should be cautious about that. If you're going to hold ETFs, you probably should diversify across custodians. But I also think that, it's good to take self-custody. And so, we'll see where that shakeouts over time. But I think that that's just an inevitable stage that Bitcoin was always going to go through if it was ever going to get as big as it has now. I mean, I think there's a risk, but I view it as overblown because I view Bitcoin as well-designed as is. It has a block size limit for a reason. And, I think that basically the market forces will play out. I think, basically, if you view what Bitcoin is Bitcoin is the most immutable and decentralized database we've ever made as humanity. I think the biggest killer use case for that is money. If you have a really good decentralized open ledger, money is like by far the biggest addressable market for that. That's like $100 trillion market in today's dollar terms. That's like it's a massive market. The total addressable market for that, in theory, is huge. And you can use that. You can timestamp other things to prove that they were not changed. You can use it for speculative meme tokens. I think most of those that's like, at most a few $1 trillion market, non-monetary use cases for the most immutable database. I think that over the long arc of time, the monetary use case is way more denser. It's a way bigger market, and it pushes that aside. I think that while Bitcoin gets adopted, as it goes through, as more people look at it and figure out things they can do with it, it goes through these manias, it goes through fads. I think they burn themselves out over time. We see when you look at the altcoin space, you go through this boom for a period, and then we forget that narrative. We go through the next big boom, and then we forget about that narrative. We go to the next big boom. Now, kind of the current cycle is nothing particularly new, but taking some of that other stuff and putting it on Bitcoin. I think this is going to go through a big boom, and then that kind of washes itself out. And I'm sure someone will think of the next thing, and it will go through that fad, and that can be disruptive while it happens. But I think that ultimately that it's not particularly economic. If people want to, if there's demand for meme coins, there's an endless supply of meme coins that come to the market until they saturate that demand. And then all those people that bought meme coins basically get poor. And then the money flows to the miners. And it's annoying for people that are trying to use Bitcoin monetarily for that period of time. But at the end of the day, they still have their money. All the people that bet on JPEGs and meme coins are poorer now, unless they were the handful of sharks at the top. They were basically shilling it and cashing out at the top. And, those kind of sharks make money, but most people lose money. And then it kind of goes back to stability. So I think that's kind of part of something that it has to go through.
Alden emphasizes the importance of self-custody and the need for investors to diversify their holdings across different custodians to mitigate risks associated with centralization. While ETFs provide a convenient entry point for many, maintaining self-custody of Bitcoin remains crucial for those who prioritize decentralization and security. Alden views Bitcoin as the most immutable and decentralized database humanity has created, with its primary killer use case being money. The total addressable market for a decentralized digital money system is enormous, potentially reaching $100 trillion in today's terms. Bitcoin's design, with its block size limit, supports this function effectively despite its scaling and fungibility limitations over time. Bitcoin is likely to see continued adoption and use as digital money, overshadowing other non-monetary uses. While there will be periodic fads and manias within the cryptocurrency space, Alden believes these will burn out, leaving Bitcoin's monetary use case as the dominant narrative. The cycles of boom and bust in altcoins and meme tokens highlight this, where speculative bubbles form and burst, ultimately reinforcing Bitcoin's stability and utility as a form of money.
Bitcoin is really good money, but it's not perfect money. There's certain limitations with say scaling, certain limitations with fungibility, which impact privacy to varying degrees. And there's tools that can overcome that on higher layers. If a lot of people buy into, say, ordinal theory, and they say, okay, this is the quote unquote ordering of sats that we agree with, that does give chain analysis companies a lot of tools and incentives. I think, unfortunately, over the next decade, they're already going to have a lot of tools and incentives because governments have a lot of tools and incentives to surveil all this as best they can. And for people that follow my macro work, I'm focused a lot on the topic of fiscal dominance, which is that a lot of debt is now on the public ledger for governments, sovereign debts, and they get in a situation where if they keep interest rates low, they risk inflation, and if they raise interest rates, they actually blow out their deficits even more and fuel inflation in a different way. And so historically, what countries do when they get to that situation is they turn to capital controls. They try to say, well, banks are controlled now and brokers are controlled now, and you can't buy this type of security, you can't buy this type of asset, or gold's illegal to own, or foreign currency is illegal to own, and they turn to all those things. And Bitcoin is a it's a release valve for that, right? It's portable capital, and if you're trying to do capital controls, you don't particularly like the fact that that exists, or if it does exist, you want to surveil it as much as possible, so that if some billionaire or some company starts putting a lot of capital there and then trying to evade the fact that all the inflation's happening, they can go to that entity and be like, well, we're going to tax you by 20% to recoup some of the value that you escaped from the inflation with, or we're just going to confiscate your coins, whatever the case may be. And so governments have a lot of incentive to try to do that. And so I think, ordinal theory or not, just chain analysis is going to be a problem for the next 5-10 years. I've been saying that I think privacy is the biggest kind of battleground in this space going forward. And I think it's not something that's going to be won a year or two from now. I think that's going to be a long-term issue. That's also why I think public education is important. Like propaganda works, right? If you tell people, look, our currency is broken because there's outside entities attacking it, that a lot of emerging markets will use that line. Or, hey, our currency is working, but all these Bitcoiners are greedy, and they're, the fact that they're, not buying into our money is breaking our money now, and we got to go and tax those, right? Those narratives can work, unfortunately. And so that's actually why I think Bitcoin education is so important, that you need enough knowledge out there that as the government tries to apply these different types of tools, that there's sufficient pushback among the populace for them. But I do think that, tech aside, that's just an era that we're going to go through now. And so I kind of take that that's an axiom that I start with, that we are going through an era where Bitcoin does have fungibility limitations. Governments are going to try to exploit those in any way they can. And therefore, I think it's good to build privacy tech on top of Bitcoin. And also, I think it's good to educate the public around why privacy is good, why being able to own non-debasable money is good, why the government should not have a right to do X, Y, and Z, because it helps. There's a social defense then against, large overreach in that area. In the fiat currency system, things like monetary censorship and anti-privacy things, they're pretty easy to enforce because it all happens on the institutional level. They just tell the banks, you can't send money to this, or this is what you have to check your customers for, and it instantly complied with. And because there's only a small number of enforcement points, they all just immediately have to comply. Whereas whenever you're trying to enforce something on the public level, the number of enforcement points is now 1,000 times higher or 10,000 times higher. And so the cost of enforcement is so much higher. So for example, even in the United States, when they did the gold ban, hardly anybody was actually prosecuted for it. It was very hard to enforce in practice because it was kind of like the mask is off now. They're just in your face on the individual level doing it, and it's costly. In Bitcoin, I think it'd be similar. I think compared to gold, the fact that Bitcoin on the base layer is more surveillable is a little bit of an issue, but at the same time, that's offset by how fast and portable Bitcoin is. And how you can literally do multi-sig across jurisdictions, and you can, it's much easier to move around and protect. And so I think it's gonna be a similar thing, that when you try to apply these types of things on the individual level, it's way, way, way harder, especially if there's some significant percentage of the population that is like, wait a second, that's BS, you can't do that. It worked to some extent back in the gold ban era, because so many people were kind of like, they had subscribed to kind of a collectivist view. In the United States, for example, FDR had like 70%, like he had a supermajority in Congress. That's where the pendulum swung at that time socially. But in a lot of places now, the pendulum swung in the other direction. So it's harder to do those types of things. But that's where education is important, so that there's a lot of people that are willing to push back on things when they happen.
A significant part of Alden's analysis focuses on government responses to Bitcoin, particularly concerning capital controls and surveillance. As governments grapple with fiscal dominance issues where high public debt and low interest rates create economic imbalances, they may resort to capital controls to manage these challenges. Bitcoin presents a unique challenge for such measures due to its decentralized nature. Alden predicts that privacy will be a major battleground in the coming years. Governments have incentives to surveil Bitcoin to prevent capital flight and ensure tax compliance. This makes the development of privacy technologies on Bitcoin crucial. Educating the public about the importance of financial privacy and non-seizable money is vital to build social resistance against potential overreach by authorities. Public education is a recurring theme in Alden's discussion. She underscores the necessity of spreading knowledge about Bitcoin's value propositions and the risks associated with government overreach. In historical context, like the gold ban era in the United States, public compliance was easier to achieve due to prevalent collectivist sentiments. Today, with a more individualistic society, widespread education and awareness can provide a robust defense against such overreach. Governments might use propaganda to justify restrictive measures against Bitcoin, framing it as a threat to national currencies or economic stability. Alden argues that countering these narratives with informed public discourse is essential. The more the populace understands Bitcoin and its benefits, the harder it becomes for governments to implement draconian measures without facing significant pushback. Please like and subscribe my channel.